A country is said to be in trade deficit when its imports are higher than its exports. India's trade deficit for November 2018 eased to $16.7 billion from $17.1 billion in October 2018. The difference being $0.4 billion. But the imports for this period rose by only 4.3%, while the exports grew by just 0.8%. Let us understand the factors which led to this. The crude oil impact. Crude oil prices have been moving downwards since the last 2 months with an uptick of just 4.2% year-on-year in November 2018. Given the fall in crude oil prices, it is expected that the pressure on oil imports should ease significantly. Non-oil deficit rose by 8.3 billion against 7.4 billion. The non-oil exports contracted in November dragged down majorly by a fall in exports of engineering goods by 16.4% year-on-year. The non-oil exports were driven by organic and inorganic chemicals, plastic and linoleum products, and ready-made garments, while the non-oil imports were driven by iron and steel, fertilizer, and sequential rise in gold and transport equipment imports. Weakness in non-oil exports shall remain a cause of worry going forward. We believe that apart from the crude oil price fluctuations, pressures on the global trade from the ongoing US-China trade war, and evident slowdown in the major economies such as China and Europe may continue to be a risk factor for India's exports going ahead. We expect crude prices to make a visible impact on trade deficit in the coming months and possibly ease the FY19 deficit. Meanwhile, exports shall continue to remain under pressure.